You just witnessed one of the most violent and calculated crashes in precious metals history. Silver dropped 22% in just 2 hours, falling from $90 to $73 overnight on the Shanghai Futures Exchange. Right now, Western spot silver is around $75, Western futures at $76, while Shanghai spot is still $86 and Shanghai futures at $90. That means China is still holding a $10 premium even after all this chaos. Gold is sitting at $48.21. So what really happened? Because this wasn't normal market behavior. This felt like a war. In my last video, I told you silver never got a daily close above $90. I've been warning that the $87 to $90 level was major resistance for days. So what caused this massive 22% crash overnight? Let's break it down step by step because this is where things get interesting. On Tuesday, 3 million ounces of silver were pulled out of COMEX vaults. Yes, 3 million. Nearly 2 million ounces came out of Asahi. Over 900,000 ounces were withdrawn from HSBC. Another 282,000 ounces left JP Morgan. At the same time, 2.5 million ounces were moved into a Loomis registered inventory. Overall, total COMEX silver inventory dropped to around 400 million ounces. This was one of the biggest single-day physical withdrawals we've seen in years. Physical silver is leaving the system. And here's the part that should really make you pay attention. While millions of ounces were being pulled out, more and more futures contracts were being settled with physical delivery. In just the first 4 days of February, 600 delivery notices were issued. In total, that's over 3,500 contracts, representing 17.5 million ounces of silver. Normally, only 1 to 3% of contracts settle with physical metal. But right now, it's closer to 100% physical delivery. And here's the reality. You can't build AI data centers with paper silver. You can't build missiles with paper contracts. The world needs real metal, not promises on paper. Now, compare that physical shortage to what just happened overnight on the Shanghai Futures Exchange. Honestly, this was one of the most shocking things ever seen in Asian commodity markets. In just one morning session, about 1.44 million contracts of April 2026 silver futures were traded. That equals roughly 674 million ounces of paper silver. And across all silver contracts that morning, a total of 1.34 billion ounces were traded. Think about that for a second. That's almost double the entire world's yearly silver mine production, traded in just a few hours. This wasn't small investors panicking. This looked like a massive, organized short-selling move, likely aimed at pushing prices down in the Chinese silver market. But here's the surprising part. Despite all that selling, prices didn't collapse the way you'd expect. Silver prices in China stayed at a premium compared to COMEX and London. And silver remained in backwardation, which is usually a sign of tight physical supply. In other words, all this paper trading didn't change the real world supply and demand. Then things got even stranger. Signals started showing market stress that even experienced professionals aren't used to seeing. Spot prices dropped about $9. But London moved into backwardation compared to COMEX. The exchange for physical, EFP, was signaling tight supply in London, even while leverage was being unwound in other regions. Different regions started behaving very differently. Right now, London has the strongest demand. Meanwhile, China and the US are aggressively reducing leverage and selling futures. So what does that mean? It suggests a global deleveraging cycle. Paper contracts are being sold off, while physical metal is being quietly bought and absorbed. Metal leaving the US and China looks like speculative selling, but metal flowing into London looks like real physical demand. That imbalance explains why prices are behaving so strangely. Now, this doesn't automatically mean prices will bounce back soon. Let's be clear about that. What it does show is stress in a system that relies heavily on leverage. What we may be seeing is a breakdown of the financialized, paper-driven market structure and a shift back toward real physical supply and demand driving the market. The invisible hand is no longer being guided by paper. It's being guided by real metal. The silver market isn't operating freely anymore. What used to be a normal supply and demand system has slowly been replaced by something else. Visible state action or regional rules, higher taxes, price controls, and direct government intervention. These aren't theories. This is happening in real time. For example, the Shanghai Futures Exchange just announced new margin requirements for precious metals, starting Monday. They also widened the daily price limits for silver futures to plus or minus 20%. Margin requirements for hedging positions were raised to 21%, and for general speculative positions, up to 22%. That's a big move. When exchanges tighten margin requirements like this, it usually means one thing: stress is building inside the system. They're trying to control volatility before it spirals out of control. Now, here's where things get really interesting, and I want you to really think about this. Imagine you're short silver at $70. You're confident. You believe the price will fall. You've placed your bet. But suddenly, a government steps in and sets a price floor at $80. In that moment, everything changes. You're instantly underwater. Not because of market volatility, not because of traders, not because of supply and demand, but because of policy. Silver is no longer allowed to trade below $80. That means your $70 short position is immediately locked into a $10 loss per ounce. There's no dip, there's no pullback, there's no chance to recover. Your loss is frozen in place. On a standard COMEX silver contract, that's about $50,000 gone, just like that. And it doesn't stop there. Margin requirements get raised. Liquidity starts to vanish. Brokers issue margin calls. Positions get force liquidated. You're pushed out. But here's the part most paper short sellers don't fully understand. If physical silver is tight and buyers demand delivery, your paper position can turn into a physical obligation. That means you don't just lose money on paper. You may actually be required to deliver real physical silver. And if you don't have it, you're forced to buy it at whatever price is available. Any price. Or you settle in cash, often with penalties attached. This isn't a normal short squeeze. This is something much bigger. This is a state-backed repricing. A price floor doesn't protect short sellers. It eliminates them. You can short a market. You can short a chart. But you cannot short a floor. The moment a hard floor is enforced, the old version of the silver market effectively dies. Now, could a floor be set lower than $80? Of course. But if it's set too low, another problem appears. Miners stop investing because it's not profitable enough. Refiners slow production. Physical supply tightens. Silver simply stops flowing. And when that happens, the state has only a few choices. They quietly raise the floor. They start buying silver directly. Or they subsidize the gap to keep supply alive. In other words, setting the floor too low doesn't solve the problem. It just delays it. Because the real floor isn't a number chosen by policy. The real floor is the point where physical silver refuses to sell. And while all of this is happening, mainstream media is laughing. Anchors on CNBCs are mocking silver investors, pointing out that silver fell from above $120 down to around $79. But here's what they don't emphasize. Even at $79, many silver investors are still up over 150% from where they started. They're still winning. And more importantly, they're holding something real, something physical, something that can't be printed, something that can't be changed overnight by a policy announcement. Because when markets stop being free, physical ownership becomes power. Over the past year, Bitcoin has fallen about 26%, and it's now even lower than where it was after the election rally. It basically erased all those gains. But interestingly, you don't see people criticizing Bitcoin holders with the same intensity. So let's talk honestly about both the risks and the bigger picture, because balance is important. Right now, the deleveraging is real. Speculative trades are being wiped out. Margin calls are forcing weaker investors to sell. Even experienced traders are finding this environment confusing. Markets are sending mixed signals because everything is happening step by step. Real clarity will probably only come after this wave of forced selling ends and things settle down. From a technical point of view, if price closes below 73 to 74 on a daily candle, that could open the door to 70 or even lower in the short term. That's not a prediction, just a realistic risk level based on technical analysis. But here's the key point. None of this changes the bigger structural story. Physical demand for gold remains extremely strong. Contracts on COMEX are settling in physical metal. Millions of ounces have been drained in a single day. In Shanghai, gold is still trading at a premium, even after the crash, showing strong local demand. The pricing benchmark from the London Bullion Market Association has already been set, which could trap some short sellers. Meanwhile, JP Morgan Chase likely closed massive short positions near the bottom, and demand for physical gold keeps rising. Even governments are acting. The state of Wyoming has started buying physical gold and chose a private vault instead of using big banks. That's an official move, not speculation. Big institutions are also rethinking their strategy. The traditional portfolio model, 60% stocks and 40% bonds, isn't working like it used to. US 10-year bonds have lost around 50% since 2020, while gold has tripled. Yet gold still makes up only about 1.4% of most portfolios. Imagine what could happen if even a small portion of bond money shifts into gold and silver. Silver, in particular, could benefit even more because it has both monetary value and strong industrial demand. In fact, UBS recently said they expect both gold and silver to move even higher into 2026. History shows that violent pullbacks like this often happen in long-term bull markets, and many times they mark the beginning of the next major move up. This isn't the end, not even close. Big institutions haven't lost confidence in silver. In fact, when prices are pushed down artificially like this, it actually sets the stage for a bigger bull run later. Why? Because lower prices increase real physical demand, while actual supply keeps shrinking. Look at what happened with JP Morgan Chase. They were fined nearly $1 billion for manipulating precious metals markets. They paid the fine and moved on. That alone tells you how this game works. The system is tilted. That's why many people choose to hold physical silver instead of relying on paper assets. In just 90 minutes, silver prices were aggressively smashed down. Anyone using leverage on COMEX or trusting paper silver, like ETFs, needs to understand the risk. These paper instruments often end up draining retail investors, not protecting them. Forced liquidations transfer wealth from small traders to the biggest players. You've got giants like State Street Corporation and BlackRock, along with CME Group, which owns COMEX. Same strategy, same result, over and over. Right now, paper silver and physical silver are moving in opposite directions. Paper traders pushed prices down 22% in just 2 hours. Meanwhile, physical silver keeps getting bought and removed from the market every single day. One of the clearest warning signs is COMEX settlement behavior. That's where the disconnect is showing. This reminds me of what Jesse Livermore wrote in Reminiscences of a Stock Operator. He said the market will do whatever it can to prove the most people wrong. And that's exactly what just happened. This crash wiped out over-leveraged traders. It punished people who chased the breakout without a plan. It exposed emotional trading. But strong investors, they're quietly buying physical silver at these lower levels. Weak hands got margin called. Strong hands are accumulating. So what matters now? I'm watching 3 key things. First, can silver hold the 73 to 74 level as support on a daily close? If it breaks below that with strength, we could see 70 or even lower in the short term. Second, what happens with the Shanghai premium? If it rises, that means real physical demand is getting stronger than paper selling pressure. Third, are COMEX inventories continuing to fall? Because if physical delivery demand stays high while supply keeps shrinking, that's when the real pressure begins. That's when things get interesting. Inventory keeps dropping. The squeeze isn't theoretical anymore. It's mathematical. The question I'm asking you in the comments, what are you expecting? 70 or below? Or can we bounce here? Not financial advice. I want to know what you're seeing in your analysis. 3 key takeaways. 1, this was a leverage unwind, not a fundamental breakdown. Physical demand indicators remain strong. 2, regional divergence is creating opportunities, but also extreme volatility. Plan accordingly. 3, the paper market structure is under stress in ways we haven't seen before. State intervention, price floors, margin hikes. These aren't normal market dynamics. Do your own due diligence. I will never ask for your money. Never pitch invest with me. Never run paid signals or funds. Protect your capital. Stay far away from scams using my name. If this added value, share it with one person who needs unfiltered truth over hype. The unresolved tension. We're watching a system transition in real time from paper-driven price discovery to physical-driven price discovery. How long that transition takes, how violent it gets, and where the floor actually settles, that's still being written, but the direction is clear. Invest with logic, not hype.